So you're looking to refinance your mortgage, but you're not really sure if it makes sense for you to do so, or what's some of the common reasons why you would want to go ahead with a refinance. Well, today I'm going to be going through 3 common reasons why it makes sense for you to refinance. And also I'm going to be going through a customized budget and refinance that we did for one of our clients, showing them why it makes sense for them to do the refinance and the power behind doing so. Welcome back, it's Tom here from Moffat Mortgages. Thanks again for tuning in. It's always a pleasure having you here join me. Please feel free to like the video down below, hit the subscribe button, hit that bell icon. It's always appreciated if you can do so. That way we can help the YouTube algorithm pick up this channel so more people like you can see this. All right, so again, you are looking to refinance your mortgage, but you're not really sure if it makes sense to you. What are some of the common reasons why you would want to refinance? Well, one, it would be because you would want to consolidate debt. So if you have high interest debt, you would want to absolve all that debt and put it into your mortgage, which is a far lower interest rate. So that would be one reason. Second reason, you want to pull out some equity to do some renovations. Maybe you want to do some renovations to your kitchen, your bathroom, finish your basement, whatever it is. We can use that equity to do so. Thirdly, if you are like me and you are looking to dive into real estate investing, we can use that equity to invest in a rental property. Now, with all that being said, just because refinancing can be so powerful for some people, it doesn't mean that it applies to yourself. Now, if before going ahead with any refinance, you always want to consult with a mortgage professional, whether that be me or another mortgage broker who is asking you the right questions. Be sure they're asking you, why are you doing this refinance? What is your main goal? And can you afford these payments in the future? So of course, sometimes we are going to be lowering those monthly payments through a refinance, but there are times where we might be increasing your monthly mortgage payment. Maybe we're taking out a lot of equity to invest. We want to make sure that you can afford those payments in the future. So again, be sure to work with a mortgage professional. There's also variables that you want to consider before going forward with the refinance. So for example, you have your employment situation. You want to look at your debt load. You also want to look at the difference of interest rates from what you have compared to what you're going to be having with your refinance. And most importantly, you want to make sure that the reason for the funds are viable and that it makes sense for you. So now we're going to be diving into a customized budget that I've done for one of my clients. Her main goal for her refinance was she wanted to tie up a lot of her high interest debt into her mortgage. So the benefit of doing so was A, we're not paying as much interest, and B, we were able to alleviate up to $700 of household expenses. So this was super powerful for this client specifically. I'm gonna dive through the budget, go line by line, and show you exactly how it works and why refinancing may make sense for you if you have a similar situation. All right, so let's dive right into it. This is a budget proposal that we had sent to a client, and we ended up doing a refinance for her with the sole purpose of paying off all of her debts that she accumulated while also freeing up $700 of monthly household expenses. So I'm going to go through this budget, and the idea behind doing this for you is to, for me at least, it's easier to see something visually for me to understand something. I know before I became a mortgage broker, I didn't really understand what a refinance meant or how it worked. However, with these spreadsheets, we have found that showing this to our clients definitely lets it absorb a lot easier and help them understand what we're doing here when we're restructuring their mortgage. So starting off with her budget that she currently had when coming to us, we had the amortization. So the life of her mortgage was at 26 years. So obviously she signed on to a 30-year amortization when she currently got her home, and had paid off 4 years worth of it before coming to us. Her interest rate was 3.1%, and the equity in her home after subtracting her mortgage balance was 45%, and the current property value was $850 at the time of her coming to us. So that left her with a current mortgage balance of $467. So that's how much she had left in her mortgage. which also gave her a monthly mortgage payment of $21.79, and her property taxes was $250 a month. Total home expenses, adding up the property taxes and the monthly mortgage payment, came out to $24.29. So now let's go into the debts that she wanted to pay off. She had a credit card with BMO that she had a balance of $8,200, which yielded her a minimum payment of $145 a month. Her credit card with CIBC, she was paying $100 a month with a balance of $7,500, and she had a line of credit with Simply Financial, which added up to $21,200, and her monthly minimum monthly payment was $210 on that. So as you can see, she accumulated a decent amount, $36,900 of debt there, and her monthly payments when paying off or when paying these debts, the minimum payments came out to $455. So when you add that with her total home expenses, we had $2,884 a month. So what did we do with her mortgage? So when restructuring it, we're obviously setting new terms. And with that, we have the option of going with a variable or fixed rate. And if you've watched any of my other videos, you know I'm a big fan of variable. So we had the discussion and she made the decision to go with variable. So we stretched that amortization back out to 30 years. And with doing so, that does lower her monthly payments, which I'm going to get into. Just happens at the time when she came to us, the annual mortgage rate for the variable was 1.6%. That doesn't always happen, guys. Sometimes it ends up being closer to what they already had, or sometimes if it makes sense and they want to go through with it, the interest rate can actually be a bit higher than what they currently had. But for her, luckily, it came in very, very low. Equity to remain. So we had 35% equity remaining after doing this refinance. So of course, property value does not change. The equity with that 35% ended up being $297,500. So that is the money being left in the home untapped. So with that, we are stretching her mortgage to $552, so $552,000, and that's from $467,000. So we're increasing this to a new mortgage of $552. So going down into her closing costs. Every time we do a refinance, we always have closing costs, just like a purchase. There's always going to be closing costs incurred. Now, mind you, it's a lot less than what a purchase would be. However, we do have those legal fees. We have the appraisal fee. We have the debts that we're paying out, of course. So we're wanting to pay out these debts here, all three. And then we have the mortgage penalties. So anytime you're breaking a mortgage, you're going to incur a mortgage penalty. Luckily for her, it ended up being relatively low. We have seen some pretty ugly mortgage penalties. Again, if you've seen my other videos, we've talked about this several times. It's one of my pet peeves is big banks charging huge penalties, but luckily for her, it ended up being $4,500. So we also want to pay out the mortgage. So anytime we're refinancing, we're breaking the current mortgage and we're restructuring it. So we want to pay this off. That's what that is there. So we have tax on the legal fees there. That's what that is. So the total equity takeout after closing costs ended up being $41,580. So I'm going to get into that a little bit actually. But before I do that, let's go into our total monthly mortgage payment. So we're decreasing her monthly mortgage payment down to $1,931. Now you might be asking, how is that possible if we're increasing her total mortgage amount? Well, again, it comes back to the amortization. Because we're going from 26 and we're increasing it to 30, that allows us to lower that monthly mortgage payment. Property taxes are staying the same, and we have total home expenses added up to $2181. So you can see that it's already lower than what she was paying on her current mortgage, and we're not even at the debts yet. So coming down to here, we still have the cards, obviously, so that's why we're showing that there. But we have a $0 balance, which in turn obviously gives us a $0 payment. So with that being said, we are still left with the $2181 monthly household payment, which gives us a huge savings of $702 a month. So this obviously gave her a big, big sigh of relief. She was ecstatic seeing this, and this is kind of just why I wanted to go through this, to show you the power of refinancing. And as mentioned, it doesn't always apply to everyone, but for certain people in certain situations and circumstances, it can be very powerful to do something like this. So this is kind of the cherry on top here. We didn't have to increase her mortgage amount there up to $552, but she also wanted to do some renovations to her bathrooms. So we left her with close to $42,000. That is all tax-free, by the way. Whenever you do a refinance on your primary residence, it is actually for any household, that is, it's tax-free, guys. So $42,000 she was able to use to renovate her bathrooms. So that is the budget in general, and this was a huge game changer for this client specifically. So that's it for today's video. I hope you enjoyed that one, and I hope it helped you understand how a refinance works, while also considering the different ways a refinance may help you. You know, it's not always a one size fits all, and I always like to say, please reach out to a qualified mortgage professional who's going to ask you the right questions. So again, thank you for joining me for today's video, and I'll see you on the next one.